Hi everyone, welcome to this week's lecture on bonds and interest rates. So today's agenda is the following. First, let me backtrack a little bit to discuss what we learned so far in the first 3 weeks, and then try to put today's topic of bonds and interest rates in the bigger perspective of coming up with a general theory of interest rates and why it's important to come up with different discount rates for different cash flows of varying degrees of risk. Okay, so today we'll begin our discussion on interest rates, where they come from, and how they can differ at various investment horizons. Okay, so that's our point 2 here. Number 3, we will talk about the term structure. Those of you who had some experience in finance know that term structure is just a more academic term for the yield curve. So the yield curve is a cross-section of interest rates for a specific point in time over various investment horizons. The derivation of the term structure, actually drawing a curve, is very technical and actually requires numerical analysis and lots of economic modeling and intuition. But for our purposes as practitioners, all we need to know is a rough idea of how it's derived, and we will come up with a very basic method to extrapolate the yield curve from bond prices, and then use this yield curve for valuation purposes. So at the end of the day, our concern is mainly come up with a rough estimate of the yield curve so that we can conduct valuation of companies. Fourth, we will talk about forward rates. So just to give you an overview before diving into the details, forward rates is simply looking at interest rates sometime in the future. So when we think about interest rates, we think about returns that we can get from time zero out to some fixed year, for example, 1 year ahead. Forward rates, on the other hand, we're looking at the same 1 year investment period, but 1 year into the future, for example, right? Sometime into the future. So a 1 year forward rate 1 year ahead means that I'm looking for the 1 year interest return 1 year from today. Not from time zero to time one, but from year one to year two. Okay, so this is just an example. I will talk about how it's actually extractable from the yield curve, given strong assumptions. Number 5, I will talk about bonds. So bonds, when we think about bonds, we typically think about sovereign debt such as the US Treasuries or the gilts from the UK and other developing nations. We typically talk about these bonds because they are assumed in most financial models to be risk-free. And so if you have risk-free assets being traded, you can actually derive the risk-free interest rate as well. Okay, and I'll explain to you the relationship between interest rates and bond prices. And lastly, I will talk about quantitative easing. Quantitative easing is a monetary policy action to decrease interest rates across the board in the yield curve. Okay, the reason why one might want to do this is to make credit more available for those pursuing. For those who otherwise wouldn't pursue certain investment projects. So, for example, what quantitative easing entails is actually buying the central government or the central bank buying their own debt. And by doing this, they're essentially swapping cash. They're essentially swapping the bonds that they issued themselves sometime in the past for cash. And that will basically drive up bond prices. But at the same time, that will lead to lower interest rates. And again, I'll explain to you the relationship between bonds and interest rates towards the end of today's lecture. And in doing so, credit becomes much more available because there's so much cash available on the markets. And in this way, this is one way for the central government or the central bank to stimulate the economy. All right, so this is today's agenda. So let's begin by first reviewing a bit. So far in this class, we talked about a model to value equities, and this is derived from the MPV model that we discussed in week 1 or week 2. So specifically, we talked about the dividend discount model, which is an infinite horizon cash flow model. And to calculate the MPV of this dividend discount model, we had to use the opportunity cost of equity, okay, or the willingness for an equity investor to part with their money, or the interest rate in which an equity stakeholder would actually part with their money. And so our goal ultimately, or eventually, is to come up with a theory to derive this so-called opportunity cost of equity. But before talking about this, it's probably easier to first talk about where this perhaps a baseline interest rate comes from. Okay, so let me write down our what we talked so far. So we talked about this equity cost of capital, or the opportunity cost of equity. We designated this opportunity cost with the variable RE. Okay, and we want to know where this comes from eventually. So I'm going to write, where does it come from? We'll get to that soon, but let's first begin with some more basic framework of what RE should look like. Okay, so let's first think about, if we can decompose RE, we should decompose it intuitively into 2 essential parts. One is some underlying base riskless return rate, and perhaps any sort of additional risk that equity holders have to absorb to be added on top of this base riskless rate, right? So that's kind of the first framework or intuition that you should be thinking of. Okay, so where do we come up with this riskless rate? And eventually, how do we determine this additional risk that should be added on top of this riskless rate to compensate properly those equity holders, those who are looking to invest in equities side of the firm? Okay, so you should be thinking, okay, perhaps RE can be decomposed into RF. So I'm going to use lowercase f to designate the risk-free rate. So I'm going to write risk-free rate plus, and then on this, the term after the plus, I'm just going to write the return required for additional risk on top of RF. Okay, so today our goal is to focus on RF. RF, to give you a preview, is derived from riskless assets. Okay, it is market-based. It's going to be derived from asset prices, but it's going to be riskless because the assets that it's going to be derived from are essentially assumed to be riskless. And the reason it's riskless, you can think of it in 2 dimensions. First, you can think of it as a rate that doesn't change over time. So firstly, there's no risk because, number 1, it is fixed or guaranteed. So it's known beforehand what that rate should be across time. So no variance. No variance. So that means that investors know beforehand how much they will get, and there's no uncertainty or unknowns of what that value should be 1 year, 2 years, 3 years out. Okay, so it's known. Everything is known today. Everything is known upfront. And number 2, we assume that there is no what's called counterparty risk. This is basically assuming that the country that is issuing this debt or institution that's issuing this debt will not default. Okay, that means that they will not end up not servicing their debt issuance. So they will. It is essentially 0% chance that they will fail to pay interest, continuously over time, and also return your money at the end of the maturity of this asset. Okay, so let me reiterate again. RF is going to be derived from a riskless asset, namely, it's going to be derived from bonds. Okay, and more specifically, it's going to be derived from bonds that's issued from institutions that, number one, they will offer a bond in which the interest rate is fixed or guaranteed or known beforehand at the time of issuance. And number two, there is no chance that they will default or fail to service the debt that they issued to the markets. Okay, so that means that interest payments will always be on time, and at the end of the maturity of this bond, the full principal amount will definitely be paid back. In these two ways, we typically claim that these assets are riskless, and therefore the fact that there's a guaranteed insurance that the country won't default, or the institution won't default, and also the fact that everything is known about the asset return beforehand, we therefore presume that the interest from this asset the return on this asset should be guaranteed or riskless. Okay. So that's what we're going to study today. We're going to figure out where RF comes from. How do we come up with a structure, a term structure, or RF for various horizons? And then we're going to talk about where they come from, namely from what type of securities and what type of institutions that you should be paying attention to. All right, so let's first just take for granted that we always have a counterparty willing to borrow from you or issue a debt to you that you're willing to pay for. Or you can assume that this counterparty is the U.S. government. Most financial institutions just presume that the U.S. government will not default on their liabilities or debt. Okay, and therefore you will always receive the money that you lent out. So let's first define what a term structure is and not worry too much where these interest rates come from. Again, just to understand the intuition of interest rates and its relationship with time horizon. Okay, so far our present value calculations, we kind of assume that the discount rate is constant, right? We just assume that, okay, maybe 1 year, 2 years, 3 years, the per annum interest rate is some fixed value. So for example, let's write out an arbitrary timeline from 0 to capital T. Let me write the timeline on top. So 0 designate time, today's time. 1 is 1 year out. 2 is 2 years out. 3 is 3 years out. And ... means there's some numbers in between, and all the way to time capital T. And we typically assume that we earn interest on whatever we invest in at time 0. So after 1 year, we would get an interest of 1 plus R1. So R1 just means some interest rate, okay? And for so far, we just assume that, okay, maybe R just stays constant, so we just receive R1 every period. The per annum interest rate is the same every period, so we just compound it twice. And for 3 years, we compound it 3 times. And all the way to time T, we would get compounding of R1 all the way to capital T. Okay? So what you should be thinking is that, is this constant per annum interest rate, is this assumption valid, and is this realistic? And of course, the answer, if you look at newspapers or if you have some background or if you traded some bonds before yourself, you know that in reality, interest rates, at least per annum, the further you go out, on average, that interest rate tends to be higher. Okay, so to answer the first question, Should the interest rate for 1 year be the same as the interest rate for 5 or 10 years? No. And the reason is because there is what's called interest rate risk. And I want to emphasize here that interest rate risk is fundamentally different than what you should expect from the return you get on equity investments. And the reason is because interest rate risk typically comes from the macro economy. It's more systematic, and it's not firm specific. Okay, it's what firms benchmark to. And so this is whatever risk that's going to be encountered at for these bonds that they're going to be derived from, it's going to be impacting all firms in general. Okay, so interest risk can come from many sources. So primarily it's going to come from lending conditions over time. Okay, and this is again not firm specific. It's typically has a macro impact. Okay, so lending conditions change, and when lending conditions change, it could be the fact that there's little investment opportunities in general, or it could be the economy is booming for otherwise, and there's lots of investment opportunities. Then that's going to impact demand and supply of credit or riskless securities. Okay, so demand and supply of riskless securities will also change, and therefore prices obviously will change. And as I will explain to you eventually, if prices of riskless securities change, then their return will change. And I will demonstrate the negative relationship between prices and return. Okay, the reason the interest rates and return are negative for riskless assets intuitively should make intuitive sense first of all, and then the math will make the relationship concrete. Okay, the reason why there's a negative relationship between prices and the return on riskless assets, because as people bid up the price of the asset, so there's more demand for riskless assets, then the offer yield should be lower, right? Think of it as you're bargaining with the debt issuer, and if everybody wants to lend money to the bond issuer, then the bond issuer can offer lower rates. Okay, so there's a negative relationship between bond prices, and the return that the bond issuer has to offer to investors. But in any case, I will use math to make this relationship concrete. So our learning objective today is the following. First, we will talk about the term structure of interest rates. And as I mentioned already, the term structure of interest rates is another way of indicating the yield curve. Okay, and the yield curve is just the interest rates that you would get across various time horizons, right? So it's showing what the return should be from 0 to 1 year, from 0 to 2 years, and 0 to 3 years, and we're simply plotting the return across these different maturities along the investment horizon, right? And that's going to give us, an upward sloping or potentially a flat or even a downward sloping curve, okay? And as I will show you an example what a term structure looks like. Second, we'll talk about bonds. We'll talk about the definitions of what bonds are. I kind of already explained with examples what bonds are. It's kind of fixed payment. It's something you've seen before. It's fixed cash flow that you know beforehand what it looks like, and but you get a principal back after lending some amount of money in the beginning. Okay, so then I already kind of explained the intuition between bond yields and prices a little bit. And most importantly, we will be talking about treasury securities. So treasury security is a name that we designate for bonds that's issued by the U.S. government. And typically, finance practitioners presume that bonds issued by the US government is close to riskless. So we presume that US bonds are close to riskless securities. Okay, and final topic, I will give you an overview of quantitative easing and provide examples of how monetary policy can change interest rates for the sake of providing more credit in the economy and making borrowing easier to finance potentially worthwhile investment opportunities. Okay, so let's talk about term structure of interest rates. Okay, so let me again give you what this looks like from a time horizon perspective first of what term structure is telling us. So let's draw a timeline from time 0 to, let's say, 1 year, 2 years, and 3 years. So what the term structure is basically doing, the term structure is plotting interest rates along the y-axis. Okay, so I'm going to use I to indicate interest rates in general. And then the x-axis is the investment horizon. So I'm going to use T to indicate the investment horizon. And so at the 1 year mark, what it's looking at is at the interest rate return you would get from a riskless investment from 0 out to 1 year. So that means if you lend out $1 today at time 0, you'll get your $1 back 1 year later plus some riskless interest rate when you receive your principal back. And you would plot that interest rate return at the 1 year mark for the term structure. Okay, so let's suppose that you get 1% back, and therefore you would plot a point there. Okay, same thing for 2 years out. You're looking at the investment you return from 0 to 2 years. So for example, if you had $1, you lent it out to somebody at time 0, 2 years later, you get your $1 back plus some riskless rate. And suppose that interest rate that you get at the end of 2 years is 2%, for example. Then for the term structure plot, you would indicate a point at 2 years and then 2% on the y-axis. So you keep doing that for every time horizon, and we would typically draw a curve to connect all the points, and that is what a yield curve really is. Okay, so it's a cross-section of investment returns at today for a specific point in time. Okay, so in this example that I give you, suppose we have cash flow at 1 year, 2 year, 3 years out. So this is what this means. Okay, for each of these time horizon or maturity points, you can think of it maturity points, we should actually be discounting these cash flow, if they are risk-free, at different interest rates, right? R1, R2, R3. They could be the same, they could be different, but the point is that imposing any sort of assumption that they're the same is probably too strong. Okay, so in the case in which we have riskless cash flows in year 1, year 2, year 3, and so forth, we should actually be discounting it using interest rates according to the term structure of interest rates. Okay, so given this term structure, our present value of riskless cash flow, C1, C2, all the way up to CT, for example, each of those cash flows are paid out at different time horizons, and those cash flows therefore should be discounted at the opportunity cost of riskless return of their corresponding cash flow payments at that time horizon. Okay, so just note that the 1 year and the 1 year matches up. Same with the 2 years, all the way to T years out. Okay, so in other words, we have to match interest rate horizons to the arrival time of the cash flow. So you should be asking yourself, where does R1, R2, R3 comes from? We will get to that eventually, but they are derived from prices traded on risk-free securities. Okay, so that's the definition of the term structure. Term structure, again, just the cross-section of interest rates across, according to different maturities, or at the end of the time in which you would actually receive the amount of money that you borrowed lent out in the beginning. Okay. All right. So why is there a term structure? So the term structure arises purely from the fact that we have different kind of risk across time. Okay, specific to macro risk across time. Not only different macro risk, but also different beliefs about how the economy is changing over time as well. Okay, of course, term structure can be a flat line. Okay, there are, again, strong assumptions that you would need to make in order to make that term structure flat. But typically, the term structure will have a different shape. Okay, it's not always upward sloping. It may not always be downward sloping. It could be flat and so forth. But it's important to talk about ways to kind of deviate from perfect markets, right? So let's talk about this specific example. Why would interest rate for a 1-year loan be different from a 20-year loan? So I will give you a few examples of why that may be the case, and mostly they come from macroeconomic sources. Okay. So first things first, as you can imagine, the enemy of fixed interest investments is inflation. Okay, so if you expect inflation to change in the future, then the risk-free rate should also be different in the future as well. So I'm going to write inflation risk. So for those of you who don't quite get the intuition, just think about the case in which you locked in an investment return today for a fixed return, say 5%, but inflation increases dramatically from now until the end of your maturity investment horizon. That inflation will devalue the investment return because the currency value is essentially decreasing over time up to the point of maturity. Okay, so it's eating away at your investment. That's why inflation risk is a potential problem for bond investors, and it's important, and that's why you get securities that are traded at different prices because of this differences in inflation expectations across time. Number two is possibly you may get a non-flat term structure because you may have different liquidity demands demand and supply for different investment horizons. So I'm going to write liquidity risk. So let me give you a concrete example. Suppose most institutional investors like to hold 10-year treasury bonds, and buying and selling 10-year treasury therefore is very liquid. Okay, so there's lots of people issuing 10-year bonds, specifically the U.S. Treasury. They like to issue 10-year bonds because institutional investors, such as mutual funds, want to put those securities in their portfolio, right? In their portfolio construction, they need to diversify enough with various amounts of risk across different assets, and but there has to be a long enough investment horizon, and 10 years it typically is used as the benchmark. However, if you wanted to invest in a different time horizon, such as 5 years or 7 years, they tend to be less risky, less liquid. And if that's the case, then you would want a premium on top of that bond, right? In other words, when I say liquidity, it means that suppose you are the bond investor of a 7-year interest rate return, but if you wanted to liquidate that bond anytime before maturity, it's going to be difficult because there's not going to be a lot of investors wanting to buy that 7-year bond, and so you will demand a higher return on that bond. Okay, so that's what this liquidity risk is, right? Because you want to be compensated for the additional risk that you may be unable to sell this 7-year bond that potentially very hard to find a buyer for. Okay, so that's liquidity risk. Number 3, another possible source of a term structure, a source of a non-flat term structure is counterparty risk. So as you can imagine, firms, financial institutions, central banks, they will issue a wide range of bonds with different maturities, right? You have bonds that mature within 5 years, bonds that mature within 10 years. But if there is a higher chance that this institution goes bankrupt or defaults 10 years out, then bond investors, or if you were a bond investor, you would demand a higher return on holding on to those longer maturity bonds. Okay, in that case, in which there is a counterparty risk, you can expect a different interest rate, for longer termed bond securities. So, for example, during the financial crisis in 2008, Greece had lots of counterparty risk because they were running out of money. People believed that they couldn't service their debt, or they needed to restructure their debt, and so longer term securities were priced had a yield that basically speculative grade investments. Okay. All right, number 4, we can also have changes in investor sentiments and expectations about the economy. Changes to investor sentiments, expectations on economy. All right, so again, we're trying to think of reasons why the term structure can deviate from a flat line. And the reason, again, is because if you believe, so in this case, if you believe that the economy will do well in the short term, perhaps in the first 5 years, the economy is growing, demand for credit is really high, and therefore, banks and interest rate offering institutions will compete for, won't have to compete too hard to lend money to these people looking to finance their projects. However, in the case in which 10 years out, people expect the economy to shrink, then the banks and interest rate offering institutions would have to compete much harder to finance profitable projects, and therefore they will offer lower interest rates, for example, and in this case your yield curve would be downward sloping. And lastly, we could have different expectations about monetary policy. So for those of you who have experience, just reading the newspaper, you will have noticed that within the last year, several central banks have conducted not only quantitative easing, but gradually reduced the overnight lending rate between banks basically back to the zero interest rate level. Okay, so simple adjustment of simple changes in expectations of how the central bank adjusts the interbank lending rate can have an impact on the yield curve. Again, it's related to changes in investor sentiments about the economy. It's kind of the same thing. So if you expect the monetary policy to, for example, decrease interest rates over time, then you should expect the yield curve to also reflect that beliefs. At whatever time horizon you expect the central bank to cut interest rates. Okay, so let me summarize a little bit what we talked about. So why should there be a difference between a 1-year interest rate return on a riskless asset versus a 20-year return on a annual? Okay, so 20-year return on a riskless asset. So remember, this is per annum. Okay, this is also per annum. So I'm not comparing the effective interest rate return from 0 to 20. I'm taking the average annual rate. Okay, so 1 year versus the average 20-year. This is also per annum. And the question is why there's a difference. There's a difference because of potentially of the 5 reasons I mentioned. There could be inflation risk. There's differences in expectations about future inflation. If there's differences in liquidity risk in the type of assets. For example, if the 20-year bond that's being traded is more liquid than the 1-year bond, then you're going to have a difference in interest rates, most likely. Number 3, counterparty risk. If you think that in the long term, the risk of default is higher for the bond issuing institution, then you most likely will observe differences in R1 and R20. And number 4, you have changes in investor expectations about the economy. Again, if 20 years out you think the economy is going to improve compared to 1 year out, then you're going to have differences again between R1 and R20. Lastly, expectations about monetary policy. Again, similarly, if you expect future changes in monetary policy, then you're going to have differences between R1 and R20. So R1 versus R20. So our assumption that we've been working with so far is that, in general, we should kind of just assume R1 and R20 are the same. But in reality, that's not necessarily true. Most likely not true. In fact, we could have R1 greater than R20, or we could have R1 is less than R20. They're all possible. Okay. So to reiterate again, R1, R20 are both per annum interest rates, but R20 is an average over 20 years, right? So if it's a 20-year horizon, then divided by 20, and that gives me the per annum rate, and that's definitely going to be different than R1 because of all these differences in risk perception across time. Okay, let me give you an example now of what a term structure looks like. So in this slide, on slide 10, I give you 3 term structures, okay, at different points in time. The blue line is the term structure of interest rates at the end of November 2006. The yellow line is the term structure of interest rates at the end of November in 2007, and the red line is the term structure of interest rates at the end of November of 2008. So we're all looking at the end of November, but across 3 different years. And as you notice that this is around the time of the financial crisis. And you should notice one glaring feature here is that in 2006, we basically see a downward sloping yield curve, which is not surprising, right? Given in hindsight, given that a downward sloping curve typically indicate of a future contraction in the economy, which it did, right, in 2008. And 2007, we observe a flat yield curve, basically. But in 2008, after the central bank decides to conduct quantitative easing, we see an upward sloping curve. Okay, in typical normal scenario in which we believe that the economy will grow over time, that's the red curve essentially represents that. But this in 2008 is kind of artificial because of quantitative easing, the central bank intentionally depressed short-term interest rates, and again, to stimulate the economy by making credit easier to get for businesses and other institutions that have profitable projects. Okay, and so each of these lines, their corresponding points are listed in the table on the left-hand side. Okay, so 0.5. So 0.5. In the first column, 0.5, 1, 2, and so forth, indicate the investment horizon or interest rates for the interest rates. Okay, so 5.23% is in per annum terms. 1 year out of 4.99 means that if I invested in this interest rate for 1 year, I would get around 5% back. Okay, this is in November 2006. But in 2007, you'll see that the 1 year interest rate actually drops to 3.16%. And in 2008, somewhere close to 0%, which is not surprising because we were at the zero lower bound by then already. Okay, so let me write some descriptions here just to remind you what I just said. So this, okay, so just to emphasize, this is the end of month EAR. So remind you, EAR means effective annual rate. So everything is consistent across, everything is comparable across time. Okay, they're all in the EAR standard. In the top yield curve, I described it as downward sloping. And remember, downward sloping can represent many things, but in this case, downward sloping is an indication that the economy will contract in the future. And so growth will slow down, and interest offering institutions will have most likely compete for projects, and therefore interest rates will be cut down, right? In November 2007, it's more or less flat, so I'm going to write flat. And November 2008, we received a upward sloping. We have an upward sloping yield curve. Okay, and just to remind you, this x-axis is the maturity contract, the maturity term of the debt contract. So debt contract maturity term, or the investment horizon for a particular interest rate. So we didn't talk about maturity yet, but I'm kind of using investment horizon and bond maturity interchangeably. Okay, and the reason why we see a depression in the short-term interest rates, as you can see, it's going from 5% all the way down to 0 and 1%, is because we have not only quantitative easing, but we also had what's called flight to safe assets, right? Or interest rate cuts. So two sources of possible that can cause interest rates to decrease in the short term. One is that the central bank is cutting interest rates at that time. In fact, they cut all the way to 0% by December of 2008. And so we saw this term structure, therefore, in the short term, to depress significantly. And second, people's beliefs about the short-term performance of the economy to also decrease. And so we see investors shifting their investments from something that's more risky, such as stocks and corporate bonds, to more safe assets, such as treasury securities. and in doing so, that will bid up the price of short-term treasuries, and therefore the interest rate offered can be much lower. And that's why we see that the return on these safe assets declined over time. Okay, so let me reiterate again the mechanism through which this flight to safety impacts interest rates. So if we have a increased demand for safe assets, that's going to lead to an increase in prices of those safe assets, and ultimately those interest rate offering institutions can reduce the return on those safe assets. So interest rates will decline. Okay. So why, just to give you intuition, the government can borrow cheaper, since everyone wants to lend to government. Okay, if everybody is competing to lend money to the government or buy its debt, then the government doesn't have to offer so much money, interest in this case, and therefore interest rates are lower. All right, so let's do an example using these numbers in this slide on how to discount risk-free cash flow to get the present value of a security or a project that has riskless cash flows. So on slide 11, we have an example here in which we have riskless cash flows that pays out, let's say, $50 every year for 4 times. So you should notice that what's going on here. Sorry. All right. Let me emphasize what's going on here. So we have $50 emissions of riskless cash flows for 4 periods. You see 4 periods because we see it in 2007, we see it in 2008, we see it in 2009, but we also see it in 2010. So there's 4 payments of $50 across time. But at the end of end of the month of November in 2010, we also get a $1,000 back as well. So this 1K was presumably our principal that we lent out. Okay, so 1K is principal that was lent. So therefore this cash flow looks like a bond essentially. All right, so we have the following cash flows: 4 payments of $50 and 1 final payment of $1,000. And so I ask you, what is the present value of this security cash flow as of November 2006? And also, what is the present value of the last 2 cash flows as of November 2008? So we're going to use the term structure and match these cash flow payments with the corresponding maturity interest rate return horizon, investment horizon, in the previous slide. Okay, so let's do question 1 first. The question 1 asks us to find the present value of this security contract with riskless cash flows for 4 periods as of 2006. So I'm going to write present value 2006 because we're pretending that time 0 is at the end of 2006. That's going to equal to 50. So I'm going to write out 50 for 4 periods first. And then 1,050 in the last period. And we're going to figure out which interest rate to use now. Okay, so remember, we use the term structure in which time zero it matches the year. Okay, so for 2006, we're using the 2006 term structure. So that is the blue line in the slide, in the previous slide. Okay, so we're going to use 1 year, 2 years, 3 years, 4 years out. So these four numbers. Okay, so remember 4.99, 4.8, 4.72, and 4.63. Okay, so that's what we're going to do. We're going to use, remember those numbers again. It is 1.0499, 1.0480, and because it's per annum, I'm going to square it. Okay, and for 3 years out, it's 1.0472 cubed, and the last number is 1.0464 fourth power. And that's going to give me a present value of $1,012.81. Okay, so just to reiterate what we just did, we took those four $50 cash flows plus the final principal payment at the end of the 2010 year, and we discounted each of those cash flows corresponding to the risk-free interest rate that we got from the term structure, matching on maturity or the investment horizon. So for the first year out from 2006, we got 4.99%, and then 2 years out, 4.8%, 3 years out, 4.72%, and 4 years out, 4.64%. So that's question 1. For question 2, we are pretending that we are now in 2008. And so we're going to match that 2008 with the 2008 term structure and look 2 years out, right? Because this security will terminate in 2010. So the present value, 2008, is equal to only one $50 payment plus a principal payment of $1,000 and another $50 interest payment. Okay, and we're going to match these time horizons as of 2008 with the corresponding investment horizon for each of these cash flows, again, as of 2008. So for 2008, we go back to our table, and since our security matures in 2010, we only had to look at 2 years out. So there's only two numbers we have to care about, which is 0.91% and 0.98%. So we're going to use these two numbers to discount the last two payments, cash flow payments of our security. So the discount rate for in 2009, therefore, is 1.0091, and the discount rate for 2010 is 1.00982, and that's going to give me 1079.27. Okay, so that's how we use the term structure to discount risk-free cash flow. Okay, and so this example is what we typically call a bond, right, with so-called coupon payments. In this case, this security pays out $50 coupon payments for 4 years with a final principal payment of $1,000. All right, so that's how we use the term structure to evaluate or to assign values to securities that pay riskless cash flows. So that's kind of the important takeaway. We can do this because the cash flows are riskless, and therefore the opportunity cost should be riskless asset returns, and we use the term structure to discount these cash flows back to time zero to get the price of this security. All right, so let's move on to forward rates. So forward rates is useful from the perspective of forecasting interest rates, short-term interest rates in the future. And a good example of using forward rates is when we talk about mortgage valuation. Mortgages, as you probably already know, there's essentially two types of mortgage contracts. One is a fixed interest rate contract, in which the interest rate that you would pay on borrowing a lump sum of money to buy a house is determined at the time of contract signing. However, that may not always be beneficial if you expect the interest rate to go down further, for example, in the future, in which case a flexible interest rate mortgage or adjustable interest rate mortgage might be more attractive. However, it's hard to value flex adjustable mortgages because we would have to know what these future interest rate looks like. Lucky for us, if we make some minimal assumptions, we can actually attempt to forecast these interest rates that is typically used to benchmark the interest that you would pay under an adjustable mortgage contract. Okay, so let's first talk about the definition of a forward rate first, and then explain to you how to extract the forward rate from using an example. All right, so the forward rate derivation actually arises simply from the law of one price. So if you assume that, for example, that there's no counterparty risk, the likelihood of finding another lender or borrower is negligible. There's very little transaction cost that's specific to certain maturity contracts, debt contracts, whatever. In this scenario, then the law of one price naturally gives us a derivation of the forward interest rate. Okay, and we can do this by observing two types of risk-free cash contracts. So I give you two ways to think about borrowing money at the risk-free rate over time. So number one, imagine you need to borrow some money over a long period of time, say 2 years. So in this case, we will borrow some amount of money for 2 years, and you can go, there's two ways to go about this. You can actually go ahead and lock in an interest rate today for 2 years. So at the end of 2 years, you would repay that lump sum plus interest on top of it, but you would know that interest at the time of issuing this debt. Or you can issue for 1 year and then roll over that debt for another year, right? Assuming that there's no so-called rollover risk, meaning, again, no counterparty risk, the likelihood of not finding a lender is close to zero. In those scenarios, these two strategies should yield you the same present value. Okay. So let me explain using some math. So for example, in the 2 year, your interest payment would simply be R1 plus R2 to the second power, because R2 is, we presume R2 is already per annum, okay? And then we compound it twice at the 2 year interest rate. And that should give you the interest that you would need to pay on top of your principal that you borrowed. Alternatively, you could borrow for 1 year. Again, this is effective annual rate, okay, per annum. And then at the end of the 1 year, you would borrow again for 1 year more, okay? And we're going to use a different variable called f. Okay, so F11 means the 1 year interest rate 1 year from today. So let me write F11 equals the 1 year. There's a specific term. It's called the spot rate in the future. Okay, so this is different than R1, right? R1 is from time 0 to time 1. The investment horizon is borrowing today and then returning that, getting returns 1 year out. But F11 or F11 is the 1 year return if you invested or lent out money 1 year from today, and then having to receive interest 1 year later, 2 years out from time 0. So it's different, right? It's not the same as R1. Okay, so given efficient market conditions such as transaction costs and no inability to find a counterparty and so forth, no rollover risk specifically, then these two cash flow payments should give you the same present value. Okay, if there are differences, then you can buy low and sell high, right? Because again, their cash flows are identical and their future cash flows are identical, and then if they have different prices, then there is arbitrage opportunity. Law of one price says that securities that have identical future cash flows should have the same price. Okay, so otherwise, borrow low, lend high, and then you'll have riskless profit. All right, let's go through an example using this 2 year to give you a precise formula for the forward rate. So consider a 2 year borrowing example from above. Suppose you borrow $100 and will pay it back in 2 years. If you get a 2 year loan, you will get the following, right? You simply return $100 plus interest for 2 years at the 2 year per annum rate. Alternatively, you could also borrow for 1 year and then roll over that for another year after 1 year has occurred. Okay, so that's 100 times 1 plus R1 times 1 plus F11. And given the law of one price, given identical cash flows, future cash flows, the prices should be the same. And we can set these two equations equal to each other and then solve for F1. So as you should already see, the 100s cancels out. You divide both sides by 1 plus R11, and then you subtract 1 from both sides. Afterwards, you will arrive at this following expression here. Okay, so you can do this for you can calculate this forward rate as long as you have data points along the term structure. Okay. All right, so in this slide, in slide 16, I will simply go over some definitions, and I will go over an example of adjustable rate mortgages and fixed rate mortgages in a separate video because it requires me to go through Excel. All right. So just to give you some institutional details, maybe you've already looked into buying houses, and in any case, if you are considering buying a house in the future, you should first educate yourself what kind of contracts you may be engaging in the future. All right, so adjustable ARM mortgages just means that at one point in time you may start out with a fixed interest rate, but over time your new interest payments will be adjusted year after year. Okay, and it depends on some benchmark. Typically, it's benchmarked to some risk-free return, such as some kind of treasury yield or interest rate. Fixed rate mortgages is just a fixed rate, a fixed interest payment mortgage contract. Okay, so it's more or less like you are issuing a bond and you have to pay interest payments, but that interest payment is known at the time of contracting. So let me give you an example of a adjustable ARM. Typically, adjustable ARM is quoted in the following way. So a 5-1 ARM, for example, means that in the first 5 years, you will have a fixed interest rate, and then followed by rate adjusted every year. Okay, and this adjustment is typically benchmarked to an index and then plus some margin. So this one indicates the margin, so like a fixed term that's added on top of this index. So for example, you could have an index rate plus some constant or a margin. So in this case, this is 1%, but this can change year over year. Changes year over year. Okay. So as you can see, this is allowing yourself to be exposed to some kind of risk, and therefore you can think of fixed interest rate mortgages as some kind of insurance, right? Because once you have a fixed rate, you no longer are exposed to interest rate fluctuations that cannot be known at time zero. Okay. So insurance is, you can think of the fixed rate as an insurance, or more specifically is protection from interest rate risk. So as you can imagine, fixed rates tend to be higher in general than ARMs, in the beginning at least, or on average. All right, so slide 17 I will go over in a separate lecture video. It is an example when comparing adjustable mortgage rates and fixed mortgage rates. Okay, so I'll skip this for now. Okay, so back to the shape of the term structure. As I explained already in the beginning of this lecture, the shape of the term structure can change simply based on sentiments or changes in future expectations about macro variables such as inflation and the growth rate of the overall economy. And so this is a representation of, you can think of it as expectations about the overall growth of the economy over time. What I'm plotting here is the 5-year constant, I'm going to put this in quotes, constant maturity rate or interest rate, risk-free rate. So what this means is that, as you know, over time, a 5-year bond, its yield doesn't stay fixed, right? So what constant maturity means is that we are either tracking the closest security that will expire within the next 5 years. Okay, so we're not tracking the same security. It's whatever security that is closest to expiring within 5 years or maturing in 5 years, and therefore pays an interest. You recover your investment 5 years from today. Okay, and therefore the x-axis is the time at which we are looking ahead 5 years. All right, so what you should notice is that there's a contrast between the red and the blue line. So what I'm doing is looking at this 5-year constant maturity rate or interest rate for 5 years, and you'll notice that the shape of the curve will change over time. In fact, for the red line, you'll know that the red line indicates that the yield curve is inverted, meaning it's downward sloping. So inverted here means downward sloping. and increasing means upward sloping. So to reiterate, upward sloping means that people are expecting the economy to recover in the future, perhaps in the long run. An inverted yield curve means that in the medium to long run, the economy most likely will contract. And in fact, you can see that the yield curve, the shape of the yield curve, in fact, you can think of the red and the blue as, the slope, right? The slope. So I'm going to highlight slope. So whenever the yield curve inverts or is downward sloping, then what follows typically is a period of recession or economic contraction. In fact, you can see this directly in this plot. In 1970s, you see that the yield curve inverted, and we have a period of contraction in this gray highlighted area. Same thing for 1974, same thing for 1980, right? And more recently, for example, 2008, right? And also 2016, right? 2017. Actually, I think the yield curve started inverting maybe just recently, like 2019. Okay. And so what this graph essentially shows is that the yield curve is capturing macroeconomic sentiments, okay, which is different what you should expect from something more firm specific, such as the opportunity cost of capital of equity. All right. So let's finish up term structure by discussing how it's related to the Federal Reserve Board. Okay, so the Federal Reserve Board is the central bank of the U.S. And they are the ones that actually are in charge of the term structure. Okay, so to be precise, the Fed doesn't issue bonds. The U.S. Treasury does. But the Federal Reserve is concerned about adjusting interest rates. So they're the one that has an interest rate target for the economy. So if they want to speed up and accelerate the growth of the economy, they can do this through what's called monetary transmission by lowering interest rates and making credit more accessible for everyone. Alternatively, if they want to slow down the economy, perhaps inflation is getting out of hand, what they can do is they can make interest rates higher, right? And they can do this all through just buying and selling treasuries on the open market. So let me see. So to answer the second bullet point here, if the Fed wants to increase interest rates, what they can do is they can remove cash from the system by issuing debt. So you can say it's sell bonds. That's going to push down bond prices. And as you know, there is a negative relationship between prices and interest rates, and in doing so, you get higher interest rates. Okay. And as I discussed in the previous slide, investment expectations is important to determining long-term growth, and therefore that's going to be reflected in the interest rates that's demanded or being assessed by the open markets. And as I stated already, this is all done through the bond markets. And so that is the next topic of our discussion. All right, so let's talk about bonds. So bonds, as you know, strictly speaking, is simply a contract that pays cash that's known beforehand. There's no risk or uncertainty about the level of the cash payments over time, and you recover your initial investment at the end of this contract. Okay, so as I used for demonstration in the previous slides, we kind of presume that we have a cash flow contract that pays fixed payment every period, and then you receive a final payment at the end of this period. That's typically called the maturity time. Okay. Of course, many kind of institutions can issue bonds. You can have firms issue bonds. You can have cities and municipalities issue bonds. You can have governments issue bonds. But when we talk about riskless bonds, riskless assets, we are most of the time referring to bonds that are issued by countries. Okay, so I already mentioned examples of bonds. We can have government bonds. So let me give you some examples of government bonds. You can have U.S. Treasuries. So that's kind of their name for U.S. issued government bonds. And in the U.S., 98%, the value of the total debt issued by the government is around 98% of GDP, of its GDP. For UK, they also have their own name called gilts. I'm going to write GILTS. And the UK, the overall value of their debt is around 92% of their GDP. Just to give you a frame of reference of how much each country borrows. Okay, Germany. So German bonds, they represent about 45% of their GDP. And lastly, let's talk about Japan, an Asian country. They are also, their overall value of debt is 205% of GDP. Okay, so developed countries, because they are essentially risk-free, they have good credit, and as you can imagine, people with good countries or people and institutions that have good credit, many people are willing to lend to them, and therefore they can leverage up a lot with respect to their overall productivity of their own productivity, right? So GDP is a measure of productivity. All right, corporations can also issue bonds. Tesla and Apple, for example, they both have issued debt recently, I believe, within the past few years. And of course, mortgage-backed securities is also a type of debt. It's a collection of household debt and then being sold on the market, right, for investment institutions to buy and sell. So this is too complicated for us for now, but if you're interested in fixed income and credit risk, you should take that class and learn more about it. So too complicated for us, so I will refer you to C credit risk class. All right. So as you can imagine, different countries have different levels of credit risk or counterparty risk, and not all countries, you can assume that their interest that they pay is risk-free, but for the most part, the U.S. is used as the benchmark for risk-free interest. Just to give you an idea of different countries' credit worthiness, we can use S&P credit rating, for example. So there are several credit rating agencies, but the big three are Fitch, Moody's, and S&P credit rating. So you must read this before in newspapers. So Fitch, Moody's, and S&P are credit rating agencies. And countries, just like people and corporations, also have credit ratings. And for example, China has a credit rating of A+. Hong Kong, I think Hong Kong may have been recently downgraded, but at the time of making these slides, they had a AA+. Singapore has AAA, so that's one tier lower. And Thailand, just to give you a frame of reference, has BBB+. And lastly, we have South Africa, and they have BB+. So BB+ and below are typically called junk bonds, speculative. So the likelihood that you can actually recover your interest payments and principal is quite low, but they offer a really high investment return. All right, so anybody can offer a bond. Bonds are just promises to repay investors or lenders a fixed amount plus interest over time, and at the time in which the principal is returned, that's typically called the maturity date or the expiration date of the bond contract. So to give you a timeline description of what a debt security looks like, we can go to slide 22. Typically, bonds have what's called a coupon payment. So that's some per annum percentage of the principal that's emitted out to investors or lenders every year or semi-annual period. And as I said already, at the end of this contract, you get your principal back. And that's what this F variable indicates. So C represents coupon payments that is emitted out to investors or lenders every period. So typically every period is 6 months. And we've received one final payment additional payment at maturity. So T is called maturity. And that is your principal or the initial amount of money that you lent out. Or sometimes it's called the face value or par. Okay, these are all mean the same thing. And to be precise, this is also called the loan amount. Okay, and to figure out what your coupon payments look like, we simply take the principal value, multiply by something called the coupon rate, and divided by the M, which is the number of payments per year. So I will give you an example of what that looks like in 2 slides. Or yes, a few slides. Okay, so let me give you a little bit of history. So bonds in general, it's not all digitized like it is today. Bonds in the past typically are not purchaser specific, so you don't typically write the name of these bonds, who owns them. They're typically called bearer bonds. So if you own this document, then you can redeem the coupon payments every 6 months or every year. Okay, so what I show you here is a bond that's issued, a corporate bond that's issued by Pacific Railroad, which is a railroad company a long time ago, back in the 1800s. And as you can see, this document doesn't have any specific name associated on it, other than the company that's issuing it. So if you actually own this bond, you are entitled to redeem coupon payments and the principal payment at maturity. And it's called coupon payments because in order to redeem your coupon, you would literally have to tear off a piece of paper from the certificate. And that's these tickets here. right? These are so-called coupons. You would literally tear these off and go to the company office and redeem interest your coupon payments. Okay, so that's a little bit of history. So railroad bonds is a corporate bond, of course. I don't have a picture of a treasury bond, but everything is digitized now. So now all electronic. And no name associated to bonds. So long as you are a bearer, you can just redeem the value of the bond directly with the company. And whoever possesses this bond in hand is entitled to those interest payments and the final principal payment. So this kind of bonds fell out of favor around 1982. So starting after 1982, things became digitized, and a bond is issued to a specific lender, and therefore I guess it's a little bit more secure. Okay, so typically, as you can imagine, if you have bearer bonds, then someone can simply just rob you at gunpoint, and if he ends up to be the owner of these certificates, he would have the rights to redeem these bonds. So in other words, it's more or less like cash, right? Okay, so let's talk about bond yields, as I talked about before. So bond yields is the interest rate that you derive from these cash flow payments. So bond yields is related to interest rates. Sorry, the interest rate return, interest rate of return. So in other words, this is another way of saying IRR, which is another way of saying yield to maturity. Okay, so just to review the bond yield equation, the bond price equation. We look at the first equation on this slide, on slide 24. So let me first describe to you the bond payments formula. So P represents the bond price. C is the coupon payments that receive every period up to period capital T, and F is the final principal payment that you would receive at the end of the bond maturity. Okay, and so your task here, in order to derive the bond yield, or the so-called interest rate on this bond, is to find the IRR that gives you this equality. Okay, this is different than using the term structure, right? So the term structure allows you to arrive at P, right? But in order to actually come up with the interest rate associated to the price, you would have to solve for this yield to maturity equation here. So this equation here. So I pose you a final question at this slide, which is, suppose two bonds have the same maturity but have different coupon payments. Are the yields the same? And the answer, of course, is no. The answer is, I will talk more about this difference between coupon payments more in the next lecture, but the idea is quite intuitive. As you can imagine, if you have higher coupon payments, the likelihood of you receiving cash as early as possible is higher, right? Because you're closer to receiving your coupon payments if you have your principal, if you have more of the cash arriving to you. And so with a higher coupon payment, you should have a higher price. Okay. All right, so let's go through an example of computing the bond yield. All right, so in slide 25, I ask you to compute the yield of a 3-year bond with a face value of $100, paying an annual coupon rate of 10%, and it is currently selling at $103.83. So what we're going to do is essentially first set up the bond pricing equation, and then we can use the IRR equation formula in Excel, or simply just through trial and error. So for teaching purposes, I'm just going to write out some test yield to maturity, and then eventually show you that this specific yield gives me the matches with the present value that's given to us. Okay, so the price that's given to us is the present value. So this is the present value. All right, so let's write out the present value, future value equation. So we have present value equal to 103.83, and we have a 10% annual coupon. So that means that we can simply multiply 10% to the face value of $100. So $100 times 10% is 10. So we will receive $10 every year until maturity. And in the final period, we will receive our face value back at $100. So the final payment is actually $110. And we will discount each period by an average rate of return of y. Okay, and it's squared for 2 years out and cubed for 3 years out. And we will use trial and error to find which y allows us to make the left-hand side equal to the right-hand side. So I'm going to write out a table here. I'm going to vary y and see if I can get the present value to match 103.83. So I tried 3 numbers, 9%, 8%, and 8.5%. And I get a present value of 102.53, 105.13, and 103.83. So 8.5% will give me a price of $103.83. So of course you could also use the IRR formula in Excel, right, with any guess. But just a note for bond valuation, your IRR formula will always give you a unique yield to maturity. So you don't have to worry about finding multiple routes in your IRR, or finding not being able to find a yield to maturity. There will always be one unique answer. For debt contracts. All right, let's go over another example. So in example 3, we have bonds that are often quoted in terms of yield instead of price, but we can compute prices from yields. And so you are given the following information about a bond. You have a bond whose principal or face value is $100. It will mature in 4 years and has an annual coupon payment, coupon rate of 8% that's paid annually. And the yield to maturity is 0.925%. And we ask you what the price of this bond is. So since you already have the cash flow payments, it's the sequence and timeline of the cash flow payments, and you also know the yield to maturity, then we simply have to plug in the yield to maturity into the present value formula to give us the price. Okay, so let's first write out the timeline here. We have a timeline from 0 to 4 years. So let's write 0, 1, 2, 3, 4. So sorry for the unequal spacing. And we have a coupon payment of 8% per year. So again, 8% times $100 gives us $8. So year 1 we will receive $8, year 2 $8, year 3 $8, and finally in year 4 you will receive the principal plus $8. So the price or the present value of this contract, therefore, is simply the discounting these cash flow payments by the yield to maturity of 9.25%. So I'm going to write 8 divided by 1.0925% plus 8 over 1.0925% squared. Sorry, not percent. So let me start over, sorry. Yeah, so just 1.0925 plus 8 divided by 1.0925 squared plus 8 divided by 1.0925 cubed plus 8 divided by 1.0925 to the 4th power. And that will 108 divided by 1.0925 to the 4th power. That's equal to 95.97. All right, so yield to maturity and prices are interchangeable. It's just one way to quote something in another terms, and therefore what you should notice is that there is a negative relationship between price and yield, right? If I increase the yield to maturity, then that's going to if I'm going to increase the yield to maturity, that's going to increase the denominator and therefore lower the value of each, the present value of each payment over time, and therefore the price is going to be lower. So there is going to be a negative relationship between prices and yield to maturity. In slide 29, I give you some institutional details about Treasury securities or bonds that are issued by the U.S. government. And we will, in this course, use U.S. Treasuries as the benchmark for assets with zero default risk or risk-free interest rate return. Okay, and there are basically 3 types of Treasury securities. There are Treasury bills, as noted in the first bullet point, Treasury notes, and Treasury bonds. So Treasury notes and Treasury bonds are the same. They have, the only difference is that they differ in maturity. So Treasury notes are issued between 2 and 10-year maturities, and they have coupon payments every 6 months. Conversely, Treasury bonds have maturities that exceed 10 years, and they also have coupon payments every 6 months. Treasury bills, on the other hand, do not issue coupon payments, and they are typically very short maturities, issued between 3, 6 months, or 12 months. And in other words, Treasury bills are what's called bullet payments, because you simply lend out a specific amount of money, and you get simply the interest plus principal back at the end of the maturity. Whereas Treasury notes and Treasury bonds have intermittent coupon payments from the time of issuance to maturity date. All right, so how do we go about pricing Treasury securities? We can, as long as we have a term structure, we can use the discount rates associated to the term structure to value securities that pays riskless cash flows. So in this example on slide 30, suppose we have a term structure of interest rates of the following. We have a 6-month annual effective rate of 4%, a 1-year interest rate of 4.1%, and a 1.5 year interest rate of 4.3%, and lastly a 2-year interest rate of 4.5%. So note that each of these interest rates are EAR, okay, so they're comparable across each other. So to calculate the present value of $1 payment, for example, that's paid at the end of 6 months, the present value is simply 1 divided by 1 plus r 0.5 to the 0.5 power. Okay, so this is assuming that there is a risk-free cash flow payment at the end of 6 months. Okay. Similarly, for if we have a cash flow payment at the end of 1.5 years, we simply take the present value of that $1 at the end of 1.5 years divided by 1 plus r 1.5 to the 1.5 power. So what is the current price of a treasury note with 2 years to maturity, a coupon rate of 8%, with semi-annual coupons and a face value of $100? So this is the question that I posed to you at the end of this slide. Okay, and let's figure it out. So let us first outline the characteristics of this bond security. So we have first semi-annual coupons. And these coupons can be computed by multiplying the coupon rate of 8% by the par value of $100. And because they occur every 6 months, we divide it by 2. Again, remember the 8% is per annum. Therefore, we get $4 per 6-month period. Therefore, our cash flow timeline looks like the following. And so I'm going to use years here. So 0 for today, 0.5 for 6 months out, 1 for 1 year out, 1.5 for 1.5 years out, and 2 for 2 years out. We will receive $4 every 6 months, and in the final payment we receive $104 because we receive our principal back plus the semi-annual coupon, the final semi-annual coupon payment. Therefore, we can solve for the price of this asset by taking the present value of these cash flow payments every 6 months. So let's just write out the cash flow payments first. And the final payment of 104. And we will discount each of these cash flow payments corresponding to the interest rate investment horizon from the term structure of interest rates. So if you recall from the previous slide, our 6-month interest rate effective annual rate is 1.04, and I'm going to take it to the 1/2 power. Our 1 year effective annual rate is 1.04 to the first power. The 1.5 year mark is 1.043 to the 1.5 power, and the final 2-year payment is 1.045 to the second power. And if we calculate this out, we will get $106.756. 0.756. All right. So that's bond pricing. So that's how we get interest rates. So if we observe bond prices, we can calculate the IRR. If these bond prices are riskless, we can calculate the IRR to get the yield to maturity. And these yield to maturity corresponds to the interest rates on the term structure of interest rates. Okay? And once we establish a term structure, we can assign value to any securities that has cash flows that are risk-free, that pays out across any time horizon. Okay? So long as we match correspondingly to the correct investment horizon in the term structure. So the last topic I want to briefly discuss is quantitative easing. So this was a big topic at the time of the financial crisis in 2008, but it has also come to light recently in the past year, especially since the coronavirus. So let me talk about the 2008 financial crisis first. So as you know, the 2008 financial crisis was mainly driven by the collapse of the mortgage-backed securities market. And so what the central government tried to do across the world is they try to provide sufficient liquidity to banks so that they can replace, find ways to service their over leveraged investments in mortgage-backed securities. Okay, so what the Fed decided to do is they decided to inject the financial institutions with cash by purchasing treasury securities off these banks' balance sheets, in addition to mortgage-backed securities. And this was a massive amount of money, over $2 trillion in just a few months. Okay, just to remind you the mechanism, if the Federal Reserve or the central bank decides to buy back government debt, what they're essentially doing is they're swapping out government debt from the debt markets and injecting cash. And so when they decide to buy debt, they're putting pressure on the prices of these debt, and the yield to maturity therefore is decreasing. So you have more cash in the system, interest rates are falling, there's more credit in the system, and therefore you should expect a counteracting effect to an economic contraction. So let me write that down here. So buying debt will lead to increase in prices and therefore lead to a decrease in yield to maturity. Okay. So as I emphasized earlier, the Fed conducts these kind of monetary policy in order to incentivize lending and borrowing, right? To kind of get the economy start working again, so that banks are more willing to invest in profitable projects for firms or households or whatever, and therefore accelerate the economy into the future for future growth. In 2008, the Fed actually implemented QE 3 times. First in, I believe, around March, where they decided to buy MBS plus treasuries. Same thing for QE 2. And for QE 3, they bought more MBS. Okay, so QE 3 was around 2012, I believe. It's here. It's around 2012, and more MBS. Mortgage-backed securities. In QE and QE2, it was MBS plus treasuries. So this was around, QE1 was around March of 2009. All right, so let's look at some event studies to kind of understand the impacts of the announcement of QE on interest rates. So what's being shown here on the y-axis is the so-called 10-year treasury yield on the run. So y-axis is a 10-year treasury yield. I'm going to put this in quotes, on the run. So on the run indicates that we are looking at the most recently issued 10-year treasury. So on the run is equivalent to most recently issued 10-year treasury. Okay, so just to remind you, you can have many 10-year treasuries being traded, but over time the maturity shrinks, right? So we want to just look at the most recently issued 10-year treasury bond to kind of look at the fixed investment horizon that with returns for a roughly 10-year period. So in this slide 34, we have two plots where we have two different announcement times. One is an announcement of QE in November of 25, where the government the Fed announced that they would buy back $600 billion worth of MBS in November 25, and then and again in December 1st, Bernanke, so Bernanke is the Federal Reserve chairman at the time, speech to stand by for more quantitative easing. Okay? So again, these aren't actual actions. These are simply announcement effects in which investors will make adjustments based on their expectations. The x-axis in both these plots are the hourly time intervals. So as you can imagine, the central bank simply releases announcements or makes a speech, and the markets are just actively listening at the same time. And we should expect that if the central bank conveys accurate information or information that's relevant to expectations about the future economy, then investors should incorporate that information and make adjustments in their portfolios. Okay, so what you should observe in these two graphs is that if we expect the central bank to buy more assets namely MBS and bonds, the central bank is going to swap out those bonds and inject more cash into the system, and therefore interest rates are expected to decline. And in fact, that's kind of what we see in these plots. We see that the 10-year on the run yield declines once an announcement is made that indicates that the central bank is going to buy debt and therefore decrease interest rates. So as I mentioned already, QE another QE was announced in March of 2009. On this date, the Fed decided to buy an additional $300 billion of treasuries. So definitely a very clear signal to the market that the government is going to increase money supply and swap out those debt to make not only to reduce the balance sheet liability side of the bank balance sheets, but also to incentivize lending from financial institutions. So this decrease in interest rates was about 0.4%, which is a lot given that the central bank changes their interest rates at 50 basis points at a time. Okay, so this table basically summarizes the announcement effects of various quantitative easing monetary policies. So to remind you again, BP, these are all in basis points. BP equals basis points. And 100 BP corresponds to 1%. Okay? And that 4.4% that I mentioned earlier is this number here. Okay? And just to clarify, constant maturity means that the yield curve is interpolated, meaning we're connecting the dots. There may not be a security that precisely matures 10 years from the quote date, so we may have to interpolate that yield curve to get a yield interest rate. So this means interpolated yield from all outstanding traded securities, treasuries. Okay. All right, so last two plots on the effect of the QE on the market. So on August 10, 2010, the central bank decided to roll over their QE policies. So that means that they're going to keep the balance sheet of the central bank the same. So that's August 10, 2010. This is a rollover policy. Keep balance sheet the same. And lastly, September 21, they announced further possible more QE in the future of $600 billion of treasury purchase. That is, yes. So similar effects from QE2. Okay, so let's summarize the punchlines of QE. I'm going to give you two punchlines essentially, and this is more or less related from the household's perspective because we haven't talked about firms yet. Okay, the firms is a little bit more straightforward, right? If you can imagine, central banks makes credit easier. Financial institutions are more willing to lend money out, so corporations therefore has a better chance of securing loans and therefore make investments and positive NPV investments and therefore grow. And that's kind of the channel through which the economy grows through this through this interest rate channel. But the question you should be asking us is QE beneficial from the perspective of households, right? Because that's kind of what we care about at the moment, as students and as people who are not yet engaged in the not yet engaged in corporate finance outright in the industry. Okay, so first things first. Quantitative easing lowered interest rates. I think that's quite obvious that this is true. Demand pressure on the treasury market forces prices up. This causes yields to fall, lowering the term structure. However, what you should the takeaway here is that this actually increased inflation expectations between 35 to 96 basis points. Okay, so this is these calculations I didn't show you, but from research papers that's estimated, we see that inflation expectations increased, but if the nominal rates, so nominal rates are just rates being quoted, are lower, that means in addition to inflation expectations, that would mean that the real interest rates are negative. So I'm going to write real interest rates negative. So just to remind you, if you have never heard real and nominal interest rates, nominal rates just mean it's the rates that you get from these traded bonds. So nominal rates is equal to the real rates plus inflation rates. All right. So real rate of return is simply the return that you would get from in terms of goods and services rather than in terms of the currency. And so as you can imagine, increasing the money supply is going to increase inflation rate, and therefore inflation is going to make your investments less valuable. But the real rate is what we care about as economists. And so as you can imagine, if nominal rates become really, really low and inflation rates becomes really, really high, then the real rates are going to be basically zero or negative. And so that means that there's no alternative investment with lower risk. And so lenders lose real value. So let me write that down. What this implies is that there's no alternative investment with lower risk, and therefore lenders lose real value. And this comes from the fact that inflation eats up returns. Okay? So QE, you can increase investments, but it doesn't necessarily mean it benefits existing lenders, right? Okay, so the question you should be asking yourself is, at least from the household's perspective, does QE actually provide easier access to mortgage credit? So maybe you were, you didn't over leverage, and you were, fiscally responsible per individual. Does QE actually help you secure better credit in these times in which credit is much easier to access? And the overall takeaway from the QE discussion here is that not necessarily. And I will provide you some data to show you that QE isn't necessarily beneficial from the household's perspective. Okay, so in this graph, what I'm plotting here is the FICO score. So FICO score is like it's like a credit score for American citizens or people residing in the United States. So higher credit scores means you have you are more likely to pay your interest payments and also return the principal. And so therefore, if you have a higher credit score, banks are more willing to lend you money in terms of credit card credit or through mortgage credit. Okay, and so what this graph tells us is that QE actually did have a positive effect on people's FICO score or credit score. So if we look at the announcement of QE, which is around late 2008 and early 2009, from this period on, we see that everybody's FICO score essentially went up by about 50 points, right? So for those of you who are curious, what does FICO stand for? FICO is actually issued by a private company called the Fair Isaac Corporation, and it is a measure of consumer credit risk. Consumer credit risk. All right, so, but just because people have better consumer credit risks, does that mean that QE actually provided additional access to mortgage credit? And the next two graphs basically says that no, actually, there doesn't seem to be any significant changes. Okay, so what this graph shows you is the three lines. So just like the above here, I kind of gave you a different distribution, quartiles, okay? Quartile values of the FICO score. So the black line is the median value, I believe. Yes, the median value. The median FICO score in the US. The lightly dotted line above is the 25th percentile, sorry, the 75th percentile. and the dark dotted line is the 25th percentile. So regardless of what, so basically we see a shift in the entire distribution upward, right, for FICO scores. However, for DTI, so DTI is household debt divided by income. So let me write that down. So DTI equals household debt divided by income. So DTI is a measure of a individual's ability to pay back loans. Pay back loans. Okay. So similarly, the lightly dotted line is the 75 percentile. This is the median, and this is the 25 percentile. And our monetary policy shock occurs around here. And what we see is that there is lower debt, and so there is some degree of refinancing effects, right? So DTI is kind of a flow variable, okay? So people are refinancing given the lower interest rate, and therefore DTIs are lower. Makes sense. However, do people have a stronger ability to buy houses, however? And based on this other measure, we see that no. Okay, the loan size actually looks like it's smaller. Okay, so let me tell you what this graph is showing. LTV is defined as loan of first mortgage divided by value of asset purchased. So as you can imagine, this number here most likely should have dropped, right? Or at least stay the same for around this time, given the mortgage market collapse as the cause of the financial crisis in 2008. So what happened around this time? So this is the line in which the announcement of QE. We see that LTV actually dropped. So what this means is that the loan size actually smaller, most likely smaller. Okay, so again, the black line is the median LTV. This is the 75 percentile LTV. And this is the 25 percentile LTV. So for, yes, okay. So the punchline of this graphs that I just showed you. Quantitative easing didn't make it any easier to get a mortgage, at least for new houses. It did allow some investors and households to refinance their debt, but it seems quite minimal. And so it's actually very hard to change the economy through active policy, at least from the household's perspective. For firms, however, it's also actively debated. So what you should be asking is, okay, maybe central banks should just stick with, financial institutions and those that depend on these financial institutions, such as large corporations, publicly traded firms, and they're kind of ineffective at stimulating so-called fiscal policy, right? So I leave you this question here. Are central banks effective at stimulating fiscal policy? All right, so this basically concludes our lecture for this week. So today we covered the term structure of interest rates. We talked about investments with different maturities, and therefore they can have different yield to maturity. And if these assets are risk-free, such as government bonds, particularly those issued by the US government, those interest rates or yield to maturity are considered risk-free rates. And therefore, we can use these rates and construct the term structure and use this term structure to value any cash flows that are seemingly risk-free. So our present value formula has been modified to take this into account. We shouldn't be using, ideally, if we have a term structure, we shouldn't be using a fixed interest rate. We should be using interest rates along the term structure, which are derived from yield to maturity of riskless assets. So to reiterate, the term structure comes from the bond markets, specifically from the treasury bond markets or other sovereign debt markets in which we have, developed countries with good credit. Lastly, forward rates help us determine determines the optimal choice of mortgages. At least it helps us forecast future mortgage interest rates that are benchmarked to specific mortgage contracts. So I will talk about that in a separate video, given that I have to use Excel to give you the example. Lastly, we talked about bonds in general. So bond structure, we have all seen it before. We saw it in week 1 or 2 when we talked about just straight out cash flows. But the only difference here is we kind of assigned terminology to those kind of intermittent payments. So for bonds, we had so-called coupon payments that are paid intermittently before the end of the cash flow payment. At the end of the cash flow payment, we call this specific contract the maturity date, right, or the maturity year. Lastly, in the final payment, at the end of the cash flow, we recover our so-called principal, which is also called the par value or face value of the bond. All right, so this concludes our lecture for today. Next week, I will continue our discussion about interest rates a little bit more, just to give you more institutional backgrounds and additional analysis on bond valuation. Okay, so that's it for now. If you have any questions, please leave a message below or send me an email, and have a nice day.